Business owners know that taxes are not a one time a year type decision. Instead, decisions that are made in January and February compound and are ultimately recorded by December 31st of every year. So with that in mind, there's three common mistakes that we see entrepreneurs make as it pertains to their investments and taxes. The first of which is 401k contributions. It's very common when we sit down and talk to somebody, they think that all 401ks are alike. So your company's 401k is the same as mine, which is the same as your friends. But in reality, 401k plans are highly specified and highly specific to what it is that the business owner is looking to accomplish. So some standard language that people tend to have written in their plans is they'll say, all right, in order to get the employer contribution, you need to make regular contributions from payroll. In fact, they'll require that contribution happening at every single payroll. So for business owners, you'll be taking your draw. And some people say, look, the business itself makes enough money. For my salary, I'll defer as much as I can to the 401k, which makes sense. $24,500 for 2026, it goes in that 401k. But if you max that out earlier in the year, if you have bonuses that are paid to yourself through payroll, and you max that out, if your plan is written in such a way, you then will not be getting the employer contribution. Your employees will, but you've now just written a 401k plan that's not to your benefit. Instead, what you should be doing is you should be thinking about other ways in which you can get the full employer match while making your contributions earlier in the year. The second common mistake that we see entrepreneurs make is waiting too late for backdoor Roth IRA contributions. So kind of the opposite here. Again, what is a backdoor Roth IRA? A backdoor Roth IRA is in 2026, we can put $7,500 into an IRA. Goes into that IRA, and then it grows tax-free forever in a Roth IRA. So you put the money in on a Monday into an IRA, you don't deduct it on your taxes because your income's too high. So that $7,500 goes into the IRA on a Monday. On a Wednesday, we put it into a Roth IRA and we let it grow tax-free forever. Remember, in 3 out of 4 years, you're seeing the stock market go up. On an average year when the stock market is up, it's up around 22%. So with that in mind, that IRA contribution, and because it's just to yourself, there's no employer match, there's no other rules around it, those contributions should be made very early in the year of every tax year. Don't wait until April because you just missed out on that growth. The third and final mistake that we see very often with business owners is waiting too late in the year for tax loss harvesting. Interestingly enough, it's not just business owners who make this mistake, it's other advisors as well. So you kind of look at the end of the year and you'll say, okay, here's how the business is doing. We've run a tax projection. We should definitely be doing those as well. We run a tax projection and we say, all right, we need some losses. Where can we find some losses? Remember, with realized losses, you can write up to $3,000 against your ordinary income, which is your earned income, the profits from the business, things like that. But if you wait until the end of the year, and in 3 out of 4 years, the stock market is up, you might have missed your opportunity to realize some losses. So just take a look at last year in 2025. Stock market ended the year up, but if you remember back in April when stocks traded off because of the tariff news, that was the opportunity to realize some losses. So in a given year, you're going to see stocks go up, but the average pullback, right, it's kind of the bumps in the road, around 14%. When those occur, you should be realizing losses. And this is actually even further compounded if you own individual stocks. We all know that individual stocks can go up very high and they can go down very low. An individual stock, it misses earnings. Just use a big tech company as an example, okay? It misses earnings, it trades off 10%. Let's say now you're down 10%. What you would do in that scenario is you could sell the individual stock, go buy the sector index that pertains to it. So again, there's tech specific, only buy tech companies. We go and we hold that for 30 days. Now that we've realized the loss of that individual company, we get to lower our taxes. We hold on to that tech exposure, expecting the stock to rebound over time. And then in day 31, you go back and you buy the individual stock. Now what you've done is you're preventing yourself from being out of the market when the stock rebounds, and you're also realizing that loss to lower your taxes. Again, if we look at the big picture, the 3 common mistakes are: 1, not having the right 401k contributions as it pertains to your specific 401k plan; waiting much too late to make backdoor Roth IRA contributions and investments; and the third and final one is waiting too late in the year to do tax loss harvesting. Thank you so much.